Listen very carefully, because what I'm about to show you could be the difference between watching the next bull run or actually profiting from it. January 2026 is shaping up to be one of the most explosive periods we've seen for penny stocks in years. Small caps are waking up, liquidity is coming back, risk appetite is returning. And when that happens, the stocks that are sitting under the radar, the ones nobody is paying attention to yet, those are the ones that can move 5x, 7x, even 10x in a very short period of time. In today's video, I'm breaking down 5 penny stocks that are positioned to go parabolic. These are not random hype plays. These are companies with real businesses, real catalysts, improving financials, and asymmetric upside. Stocks that, if momentum hits, institutions rotate, or one catalyst lands, can move fast. This is a must-watch video if you are serious about penny stocks, small caps, and high-risk, high-reward opportunities going into January 2026. So make sure you stay until the end, because the final stock on this list is the highest risk, but also the highest potential reward. Now let's do this the right way. Early call to action. Before we jump into stock number 1, do me a quick favor. If you get value from deep dive penny stock research like this, smash the like button. Let's aim for 500 likes on this video. It tells YouTube to push this content to more serious investors. Also, make sure you subscribe to the channel and turn on bell notifications, because I post high conviction penny stock ideas, catalysts, and market updates you do not want to miss, especially when these stocks start moving. All right, let's get into it. Disclaimer, quick disclaimer before we begin. I am not a financial advisor. This video is not financial advice. Everything you hear in this video is for educational only. Penny stocks are extremely volatile and risky. Always do your own research and your own due diligence before investing a single dollar. Now, let's talk about stock number 1. Stock number 1. Let's start with a name that most retail investors are still sleeping on. Waterdrop Inc. operates in the insurtech and healthcare technology space, primarily focused on digital insurance distribution, medical crowdfunding, and healthcare-related financial services. This company sits right at the intersection of fintech, insurance, and health. 3 massive markets with long-term tailwinds. Now here's why Waterdrop is interesting going into January 2026. First, valuation. This is a company that at various points traded at a multi-billion-dollar valuation, and today it sits at a fraction of that. We're talking about a small cap penny stock with revenues that do not justify how beaten down the share price has been. This is classic market overreaction territory. Second, financial turnaround. Over the last few reporting periods, Waterdrop has been focused on cost control, efficiency, and improving margins. Revenue stabilization combined with expense reduction is exactly what you want to see before a stock re-rates. When profitability becomes visible, even at a small scale, penny stocks can reprice violently. Third, market opportunity. Insurance penetration in emerging markets continues to grow. Digital insurance platforms remove friction, lower costs, and scale faster than traditional models. Waterdrop doesn't need to dominate the entire market to justify a much higher valuation. It just needs to survive, stabilize, and grow modestly. Now let's talk catalysts. Going into early 2026, investors will be watching earnings extremely closely. Any sign of sustained profitability, improved guidance, or strategic partnerships can act as a trigger. Additionally, renewed investor interest in Chinese and emerging market tech stocks could bring sector-wide multiple expansion. Why could this stock go parabolic? Because when beaten down stocks with real revenue start showing consistency, institutions re-enter quietly, volume builds, and retail chases late. That's how you get 3x to 5x moves before most people even realize what happened. A Waterdrop is not flashy, it's not trending on social media, and that's exactly why it's interesting. Stock number 2. Now let's shift gears to a company operating in one of the most misunderstood industries in the market. WM Technology is a cannabis technology and data platform. It provides software, marketplace services, and analytics for cannabis businesses. And before you click off because you're tired of cannabis stocks, hear me out. This is not a grower. This is not a speculative plant-touching operation burning cash. This is a technology and data company that benefits from the industry without taking the same regulatory risk as producers. Here's why MAPS is compelling at penny stock levels. First, revenue. WM Technology has consistently generated meaningful revenue compared to its current market cap. When you see a company trading at a fraction of annual sales, that's a signal the market has priced in a worst-case scenario. Second, restructuring and cost discipline. The company has been aggressively cutting costs, streamlining operations, and focusing on its core high-margin products. This is what you want to see before a turnaround rally. Third, optionality. Cannabis reform is always one headline away from igniting these stocks. You don't need full federal legalization for MAPs to benefit. You just need improved sentiment, capital inflows, or regulatory clarity, any of which can cause sector-wide re-ratings. Now let's talk catalysts. January 2026 lines up with a potential macro tailwind. If interest rates are lower and risk assets are back in favor, speculative sectors like cannabis tech can explode off the bottom. Earnings showing margin stabilization or improved cash flow could be the spark. Why could MAPs go parabolic? Because it's a real business trading like it's going bankrupt. And when that narrative flips, even slightly, the upside can be violent. These are the kinds of stocks that double before you even finish reading the earnings report. Stock number 3. This is where things start getting really interesting. Lexin Fintech operates in the consumer fintech and credit services space. It provides installment loans, digital finance tools, and credit solutions. And yes, fintech has been absolutely destroyed over the past few years, which is exactly why this setup matters. Lexin Fintech is trading at a valuation that implies permanent decline, but the numbers tell a more nuanced story. First, cash flow. Despite market pessimism, Lexin has continued to generate revenue and maintain operations. The market is valuing this company as if it has no future, which creates asymmetric upside if conditions improve even modestly. Second, valuation metrics. This stock has traded at extremely low price-to earnings and price-to-sales multiples compared to historical norms. When fear is this high, it doesn't take much good news to trigger a re-rating. Third, macro alignment. If 2026 brings looser monetary conditions, consumer credit demand increases. Fintech platforms with existing infrastructure are positioned to benefit immediately without massive reinvestment. Catalysts going into early 2026 include earnings updates, guidance changes, and potential policy or regulatory signals affecting fintech lending. Even neutral news can be bullish at these depressed levels. Why could Lexin go parabolic? Because deeply undervalued fintech names tend to snap back hard when sentiment shifts. This is not about perfection, it's about survival plus stabilization, and historically, those are the conditions that produce the fastest rebounds. Stock number 4. Now let's talk about a higher quality penny stock that doesn't get enough attention. CI&T is a digital transformation and IT services company. It helps enterprises modernize their software, move to the cloud, and implement AI-driven solutions. This is not a speculative idea. This is a real business with real clients. So why is it trading at near penny stock levels? Simple. Small cap tech got crushed, investors rotated out, multiples compressed, and companies like CI&T were thrown out with the bathwater. Here's what stands out. First, financial health. Compared to many penny stocks, CI&T actually has strong balance sheet metrics, operational discipline, and recurring revenue. This is rare in this price range. Second, industry tailwinds. Digital transformation, AI integration, and enterprise software modernization are not going away. These are long-term secular trends. Third, institutional appeal. This is the type of company that institutions re-enter once risk appetite improves. And when institutions come back into small caps, prices move fast because liquidity is thin. Catalysts include earnings growth, client expansion, and renewed interest in AI-adjacent service providers. This stock doesn't need hype. It needs recognition. Why could CI&T go parabolic? Because quality small caps often lag first and lead last. When capital rotates back into fundamentals, these stocks can reprice dramatically, sometimes doubling or tripling before retail even notices. Stock 5. Now this is the most speculative stock on the list, and potentially the most explosive. New Horizon Aircraft is working on hybrid electric vertical takeoff and landing technology. Yes, this is a moonshot. Yes, this is high risk. And yes, this is exactly the type of stock that can go parabolic if one catalyst hits. Here's why HOVR deserves attention. First, narrative power. Aerospace, EV, and advanced mobility stories attract capital fast. When momentum traders show up, price action can detach from fundamentals completely. Second, partnerships and development milestones. Any progress update, test flight success, government interest, or strategic partnership can act as a major catalyst. Because speculative markets don't move logically, they move emotionally. And when the story catches fire, early positioning matters. So there you have it. 5 penny stocks positioned for potential explosive moves in January 2026. Now I want to hear from you. Which one of these stocks is your favorite? Which one do you think has the highest chance to 10x? And how would you rank these from lowest risk to highest reward? Drop your thoughts in the comments. I read them all. And remember, this is not financial advice. Penny stocks are risky. Manage your risk, do your research, and never invest money you can't afford to lose. If you enjoyed this video, make sure you like it, subscribe to the channel, and follow me on Twitter, X, for real-time market updates and breaking catalysts. Stay patient, stay disciplined, and position yourself before the move, not after. I'll see you in the next one.